The thing that's going to make your teen wealthy has nothing to do with some TikTok stock hack. It has nothing to do with day trading magic or some crypto madness just because others got rich quick that way. Trust me, that would make what I do here much easier. But it's not how real wealth works. Most parents I talk to want to teach their teen about money. But when they sit down and want to actually do it, they hit a wall. Because nobody taught them either. Schools didn't teach it. Their parents didn't teach it. And now they're supposed to pass on a knowledge that they never received in the first place, are unsure of it and stuck. If that's you, you're not behind. You're just starting from the same place most families start. And believe me, nobody taught me either. I paid as an entrepreneur and business owner for each of my mistakes with cash until I figured it out. But here's what I've learned coaching families on this for years. The families where everybody builds wealth, parent and teen, they don't start with one person teaching the other. They start by learning 5 specific fundamentals together. And once those are in place, everything else clicks for the whole family. So in this video, I'm going to walk you through all the 5 steps. And I'm going to do it step by step. And I won't just give you the surface level. In each step, I'll show you the basics to get started, and then I'll show you what the next level will look like. So you know exactly where to go from here. I'm Morgan, and at the Smart Money Family, we help parents and teens build real money habits together. Not parent teaches teen, real together. By the end of this, you'll have everything you need to sit down with your teen and start learning the stuff side by side. Step 1. The first step is the one that determines everything else. And it's the one most families completely skip. Not just with their teens, but for themselves too. Most people think getting better with money means opening a savings account, maybe setting up a budget. Well, that's fine, but it's not the foundation. The real foundation is changing how you see money in the first place. And I mean you, the parent. You need to develop an owner's mindset, because if you haven't made this shift yourself yet, this is where it starts for you too. Right now, most people are trained to be consumers. You see money as something you spend, something you trade for things. And your teen has picked up that same exact habit from you by watching you. That's not a judgment, that's just how it works. They absorb what they see. But the wealthiest families think differently. They think like owners. Owners see money as something that works for them. Remember, money works for you. Something that buys pieces of real businesses. Instead of saying, I want a new iPhone, an owner asks, who makes that iPhone? And can I own a piece of that company? That question works whether you're 15 or 45 years old. So here's how you start this together. Next time you're out with your teen or you're watching television, anyway, you see a busy restaurant or a pet store or a brand, an advertisement, whatever, you ask each other one question. How do you think the owner of this business makes money? That's it, one question, no lecture, just conversation. You're both having, for the first time probably, this conversation, but how is money made in that business is the starting point. That's level 1. Level 2, well, that's coming. Once you've both been thinking like owners, the next question becomes, how do you actually evaluate which businesses are worth owning? Things like understanding what a share actually represents, what market capitalization means. That's just the total value of a company, by the way. And how to compare whether a company's stock price is a reasonable or overpriced price. I won't go fully into that all here because this video would be 3 hours long or longer, but I've put together a step-by-step guide consisting of a guidebook and some videos that walks you exactly through level 2 for every single step in this video. If you want it, you have to comment down below, joint learning, and I send it to you. It's free, just joint learning. It's designed for you and your teen to go through together. When you both start seeing the business everywhere, instead of just products and consumer mindset, your mindset will shift. And the one from your teen too. Now that mindset shift is powerful on its own. But without the next step, neither of you will actually know what you're investing in. And that's where most families get it dangerously wrong and lose money. Step 2. This is a step that separates people who build real wealth from people who just follow hot tips on social media. And I'm not just talking about your teen, I'm talking about you again. Most adults have never looked at company financials before investing in it. Not once. They buy because someone on the internet said so, or maybe a friend said, or because the stock went up last week. And I know what you might be thinking. Financial statements? What could be more boring, right? I don't even understand those myself. Well, good. That means you're about to learn something new, a new skill alongside your teen. And that's the whole point. Just skip 45 minutes of Netflix each evening and invest that time in this new skill. Just kidding. Netflix is great when you own it as a share. You're not turning anyone into an accountant. You're both learning one skill, how to look at the company and figure it out if it's actually making money or just making noise. If it has future music or if it's worth investing in. Start with 3 numbers. That's it, just 3. 1, revenue. That's how much money the company brought in. Think of it like total sales. Number 2, profit. How much they kept after paying all their bills. Revenue minus costs. 3, debt. How much do they owe? Because a company can look healthy at the surface, but buried underneath full of debt. Pick a company you and your team both care about. Apple, Nike, whatever brand resonates in your family. Pull up the annual report. It's free. It's public. A quick search on Google for Apple annual reports and you will find it on the investor page. Then find and look at these 3 numbers together. Do that regularly. Do it for the next few months, once a month or more. And your team will be able to spot a strong business from a weak one. And here's the part nobody says out loud. So will you. Most adults don't have this skill. You're going to build it at the same time as your team, providing you don't have it yet, yeah? And there's nothing wrong with that. Now, those 3 numbers are your foundation. Revenue, profit, and debt. That's where you start. But to be truthful, there's a bit more to it. Once you and your team are comfortable with those, there's level 2. And there's other levels after that. But we're going to tackle them step by step. 6 next indicators that go deeper. Those are what serious investors also look at to really understand whether a business is worth owning. Let me give you a quick overview so you know what's coming. Number 1, revenue growth. It's not enough that a company makes money. Now, you want to know if there's money to be made next year and the last year. Is the business getting bigger or is it slowing down? Number 2, profit margin. This tells you what percentage of every dollar the company actually keeps as profit. A company can have massive revenue but tiny margin. That means they're working really hard to keep very little. Number 3, free cash flow. Cash is king. This is the real cash a company has left after paying for everything. Salaries, equipment, buildings, all of it. Think of it like this. Profit is what the accountants say you made. Free cash flow is what actually is sitting in the bank account. Number 4, debt to equity ratio. This compares how much a company has borrowed versus how much the owners actually own. A company with too much debt relative to what they own is very risky. It's like someone who borrowed 5 times their salary to buy a house. Number 5, return on equity. That's something shortened to ROE. It measures how well the company uses its investors' money to make profit. Higher is generally better. Number 6, price to earnings ratio. Usually we call that PE ratio because everybody loves abbreviations. It tells you whether the stock price is reasonable compared to how much the company actually earns, right? A very high PE can mean the price of this stock is really expensive. And on the other side, a very low PE could mean it's cheap or something is wrong. And this metric is time sensitive. A PE can be stated as current, now, which means based on last year's earnings, or forward, which means based on what the company is expected to earn next year. That's much more interesting for me. A forward P is usually the better metric because it looks ahead, not behind. Was good last year, but can be bad next year. So we want to look at forward. Yeah, so don't worry if some of this feels new, it's supposed to. The point is that these exist, and once you're comfortable with the first three, these 6 are just your next logical step. In the joint learning guide that I said to you to get, I break down all these 6 with real examples. Actual companies, actual numbers on the screen. It's just a bit too much for one video. If you haven't commented already, joint learning and you get the free guide. Now, knowing how to read a business is very powerful. But even smart people, and that includes parents, make terrible investment decisions when emotions take over. Emotions are a devil here. This next step builds the guardrails that prevent that for both of you. Step 3. Most people invest based on emotion. Whatever their friends are talking about, whatever went viral that week, that counts. Teens do it, adults do it, everyone does it until they have rules. No plan, no rules, just feelings, and that's how people lose money at any stage, at any age, in any situation. So here's what you do. You sit down together, parent and teen, and you write your family investment rules. Not rules you hand down, rules that you're going to create together because they're going to apply to both of you. For example, we invest the same amount every month. No matter what the market is doing. Market green, market red, same amount. This is called dollar cost average investing, or in the world of abbreviation, DCA. You will hear that again. It's one of the pillars of the money map investing strategies. It takes emotions out, and we don't time the market. We never put more than 10% of our money into any single stock. Another one. We don't sell just because the price dropped. We check our original reason for buying first. Write these down, print them out, both of you sign it. This is just the beginning, but it's like a contract you make with each other. And there will be more rules coming. Your team holds you accountable, you hold them accountable. That's how systems work. Discipline beats intelligence in investing every single time. Now that's only level 1. There will be more rules coming. 3 rules are the starter rules, simple and solid. But level 2, as promised, goes deeper and considers more things. Things like which criteria do you need to fulfill before you buy? How do you decide what percentage of your money goes into stocks versus safer investment? That's called asset allocation. When to rebalance your portfolio, which just means adjusting things back to your target split. You make a plan and every now and then you need to check that the plan worked out or not and adjust. And the big one that nobody talks about, when to actually sell, not out of panic, based on a clear process. These are the kinds of decisions that trip up even experienced investors. And they're all covered in the joint learning guide. Comment joint learning below if you want it. And you and your team, you can build those advanced rules then together. All right. We've covered mindset, reading businesses, investment rules. Now it's time for the step that actually puts money to work. And this is where the math gets exciting for both of you. A lot of people think investing means picking individual stocks, finding the next big winner, always on the lookout. And sure, there's a place for that down the road. But it's not where you start. And by no means do you have to go that way. You don't start there when you're 16 and also not when you're 40. Finally, you will get around it if you like to do that right. Where you start today is something called an index fund. An index fund is basically a basket of hundreds of companies all bundled together. Instead of betting on one, you own a tiny piece on all of them. It's simple, it's low cost, and historically, it's outperformed most professional stock pickers at Wall Street over the long run. Benjamin Graham, the godfather of intelligent investing, after writing a legacy of a book on how to invest intelligently, one of the key essences that comes out of that book is if you don't know what you're doing, buy index funds. Simple as that. He could have written just one sentence. Here's the part that changes everything. If your teen starts investing $100 a month at the age of 16 and keeps going, by the time they retire, that's over $400,000 from $100 a month. That's compound interest. That means your money earns returns, and then those returns earn returns again. Time does the heavy lifting. And compounding interest is something correctly referred to as more powerful than a nuclear weapon or a universal force. That might sound a bit dramatic, but when you see the numbers, you understand why. And let me show you exactly what this looks like. I'm going to pull up a compound interest calculator right now. So here we are. We landed at thecalculatorsite.com, which is a nice compound interest calculator. Here you can choose what currency is applicable for you. Some of the major ones are there. We leave it at dollar. Your teen just got $1,000 from the grandma, and that is the starting amount. And the interest rate, well, we discussed the S&P 500. This is a fund of the 500 best companies of the world, an index fund. And historically, it performs at 10 to 11% the last, God knows how many years, 50 plus. So we're going to inflation adjust that like this with 3%. So 11 minus 3 is 8. Let's put 8% as annual interest rate. That should be fairly safe, and most of the years we're going to surprise us by having much more than that. So for the years, your teen is 15, 16. Let's put 40 here for the moment. So after 40 years of having $1,000 initially invested and then reinvest 100% of the 8% interest year after year, and the interest of the interest, the compounding interest, and doing additional contributions, deposits of $100 per month, what's going to happen? Watch magic. Here we go. The start date, the best date to start was years ago. The second best date is today. So the projection for 40 years makes out of our $1,000 and the additional $100 per month, which amounts over 40 years to $48,000, makes nearly $379,000 out of that. Amazing, right? That matures 20th February 2066. And here you have the exact calculation year after year. So I suggest, this is a real eye-opener, right? I suggest you playing around here and choosing, for example, 10 years and press calculate, right? Even after 10 years and saving 21,000 in deposits, the investment amount is 52,000. And this is magic. Very cool, yeah? And if you're sitting there thinking, I wish I started at 16, you can start now. The math is different, but the principle is still the same. The best time to start was years ago, as I said. And the second best time is always today for both of you. So use this compounding interest calculator. It's an eye-opener. Type in your own numbers, see what happens after 40 years, 30 years, 10 years, 20 years, and do it together. And let the calculator do the convincing. This is nothing that is fluffy. This is solid and can be replicated. Now for your teen, you eventually want to open a custody investment account. That's just an account for a parent being a manager until the teen turns 18. For yourself, open your own account if you haven't got one already. And in our guide that I will share with you, if you text me, there's a multiple step process and some research needs to be done, who will be your broker, but this is all possible, and with the help of this guide you will have a few options of reliable brokers depending where you are in the world, and a step-by-step walkthrough. I hear you. You're saying, oh yeah, now setting up a brokerage account and waiting for Morgan's guide if you want to have it. Is there nothing I can do right now, today, while we're figuring all that out? Yes, there is. I have to say, you can. Paper trading. And paper trading just means you pretend to invest. You track everything as if it were real, but no actually money is at risk. It's the best way to learn without fear. And the best free tool for this is Yahoo Finance. Let me show you. All right. So here we go. You navigated to Yahoo Finance. Just type in Google Yahoo Finance. You will get there. You need to make an account, right? And once you make the account, you find a menu bar, My Portfolio. Once you click there, you can create a new one. And this is your portfolio. This is your watch list, your portfolio, your everything. When you click on it, select Create Manually, leave it in US dollars, and give it a name. So in my case, it will be the Smart Money Family. Create the portfolio. Easy like that. Now remember, we said we're gonna start with an index fund, an ETF, an exchange traded fund that mirrors an index fund like the S&P 500. The S&P 500 are the 500 best companies of the United States and probably the world. And this is a very good fund to start with. There are several ETFs that resemble these funds. Two I want to single out, IVV and VOO. What are these abbreviations? These are tickers that I'm telling you. With these tickers, you can find the more complex name in any software and including Yahoo Finance. So for the sake of this video, we're going to use VOO as our sample fund. You go to Add Tickers and simply type VOO, and you will see the Vanguard S&P 500 ETF. That's the one. We select it and we add the ticker. And that's all what we do right now. Okay. So while we have this ticker selected, we can see the live price. Unfortunately, markets are closed right now. So this price wouldn't be changing at the moment because I'm recording this video in off-market times. But you can see all the data of this ticker, how it changed in the last trading session. Should that be interesting for you? And before we continue with this, we need to make for our portfolio a couple of changes so that you can treat it as if it is your brokerage portfolio. For this, you navigate to the settings and you're going to activate streaming quotes. So now it will give you the appearance that while the market is open, the quotes of your stock or your ETF are changing. And more importantly, you will activate cash management. So now you can pretend to transfer money into a brokerage account, and you can handle your portfolio as if it's a real account that has cash in it. So this said, save. And now you can navigate to your holdings. And in the holdings page, you can see now there is a total cash. At the moment, we haven't got any cash, right? But this little arrow here opens another menu, and you can see we can add a cash transaction. Well, our team just got lucky $1,000 from Grandma. So these will be entered here, and we can also say a note if we wanted to. Grandma Thanks. And then we hit enter. And this changed our cash. And this resembles us transferring money into a brokerage account. Now we have $1,000. So see how easy that is to make $1,000? Yeah. Once that is done, you can see the $1,000 arriving here. And now we can pretend to buy. You can see that the price of one VOO ETF is 634. And with this price, we own a tiny piece of 500 of the best companies. Remember that. So we are very versatile. We have spread our risk and we can spend all our $1,000 all at once. No, we don't, right? So we do dollar cost average investing. Means the $1,000, we don't invest them all in the same time. We spread it over a time period. And in our example, we're just going to take 10 months. So we divide $1,000 by 10, get $100, and we're going to buy only $100 part of the VOO ETF. Most brokerages allow you now to do that. And we can activate here the view. And there you can see that I can add shares. So I'm going to add a share. And this gives me the add lot. Today, I'm going to add the share, right? At this cost price, depends. Whatever is the price at that moment. For me, this will be the price right now, but should it be different, I can change it. And now I need to put the number of shares representing $100. That's a little calculation. I will leave you to do that yourself. I think you can do it, and you will come up with 0.16. That is not super exact, but close enough. So you can see now with 0.16, I spent $101.44 to buy my share of the VOO. And that's how it's done. Now, what you're going to repeat, you're going to repeat month by month that you're going to come in here and you're going to do two things. Number one, from the $900 that you have now left, you're going to spend every month $100 to buy again 0.16 shares of the VOO. That is number one. Number two, you pretend that your team gets another $100 per month, either from the allowance, from grandma, from you, whoever gives $100, or from income streams that the team is having. These $100 you're going to transfer same way like you transferred the $1,000 into the account. And then you're going to buy also for $100 again another share of the VOO. Set a reminder in your calendar. Download the Yahoo Finance app on your smartphone. Follow along and you will get very quickly the hang of it, how you can automate it, how you can check it regularly. And I don't mean that every day you're hanging on your app, but what you want to do is really to have one set day a week or a month, depending whenever you do your transfers into it, that you follow along. And that day you transfer and you buy, regardless what the price is. The price is up, the price is down, doesn't matter. I hope that helps you along. So what do you do now? Well, track it over the next weeks and months. Every month, come back. Add your monthly contribution. Simulate injecting $100, transferring them into the brokerage. Then invest it and invest the $100 from your principal. Buy more, watch it grow. You and your team, side by side, this costs you nothing. It takes 10 minutes to set up. And by the time you're ready to open a real account, you'll both already understand how it works. Put it into a broad market index fund. Set it up more or less automatic and let time do the work. Now, that's the starting point and it's a great one. But once you are both comfortable, level 2 gets more specific, more exciting. You can touch it. Things like the different types of index funds, because not all of them track the same thing. Some follow the biggest 500 companies, the one that we just chose. Others follow the whole market. Again, others follow international companies. The sky is the limit. Certain sectors can be tracked. Very interesting. And then there is dollar cost averaging that you already started to get a taste from. Expense ratios and the tax advantaged accounts. There's a lot to learn. The joint learning guide also includes a detailed step-by-step walkthrough of how to set up your Yahoo Finance account from scratch with screenshots. So even if you're not tech savvy, you'll be fine. Comment joint learning below and I'll send it over. And when you both see compound interest with your own eyes, something clicks. Saving stops feeling like sacrifice and starts feeling like a strategy. Those steps will put your family ahead of most households when it comes to money. But there's one more step that turns all of this from knowledge into a real financial future. You're building together. Step 5. Most parents think that teens' only option is to get a part-time job. And there's nothing wrong with it, right? Working teaches discipline, and that's a good thing. But what if your teen also learned how to create income on their own terms? Every teen has a skill or can learn a skill that someone else would pay for. Tutoring younger kids, editing videos, helping a neighbor with tech. The goal isn't for them to build a business empire at 16. The goal is for them to understand that income doesn't have to come from just trading hours for dollars. And honestly, that's a lesson plenty of adults are also still figuring out for themselves. So if this sparks ideas for you as well, pay attention. And then the final piece, sit down together and build a simple financial plan. One for your teen and one for you. Not a 50-page spreadsheet, a one-page plan each. Short-term goal. Maybe your teen wants to buy something specific in the next 6 months. Maybe you want to hit savings targets. Long-term goal, maybe your teen wants $10,000 invested by the time they finish school. Maybe you want to start finally that portfolio that you have always been dreaming about. Then figure out the math together. How much per month gets you out of there? Put your plans on the fridge. Check in every month together. And again, that's level 1, a simple plan. Level 2 goes into the different categories of income streams. Active versus passive, how to price a service, and what to do with the extra income once it's really coming in. Do you reinvest it, save it, split it? There's a framework for that too. It's all in the joint learning guide and beyond. Comment joint learning, you get it. When your teen sees you doing the same thing they are doing, it stops being a lesson. It becomes a family habit. And family habits stick. So there it is, 5 steps. Shift from consumer to owner. Learn to read the business. Create your family investment rules. Start with index funds. Build income and map the future together. You don't have to get all 5 perfect right away. Pick one, start there. And here's what I really want you to hear. You don't need to already know this stuff to teach it. You just need to be willing to learn it alongside your team. When they see you learning, when they see you building your own rules and your own plan right next to them, that's more powerful than any lecture you could ever give. That's what makes it a smart money family. Not having all the answers, just being willing to figure it out together. And if you want help going deeper, comment joint learning. Every step, every level broken down for you. Thanks for watching. I see you in the next one.